Hey guys, welcome back. Let's really dig into this market chaos that is unfolding right now. We are talking about one of the most violent, synchronized sell-offs we have seen across silver, gold, oil, and crypto in recent memory. Silver just suffered a catastrophic single-day plunge of over 30 to 31%, the worst drop since 1980, erasing years of gains in hours. Gold fell sharply by 9 to 12%, its biggest percentage decline since 1983, taking it from record territory straight into correction territory. Bitcoin has been under heavy pressure, dropping below the $71,000 level and trading in the $70,700 to $70,900 range today, after shedding thousands from recent highs near $80,000 plus. Oil is not spared either. WTI crude is sitting around $63 to $64 per barrel, down meaningfully as the broader commodity and risk asset unwind continues. Trillions in notional value have evaporated across these markets in a matter of days. Liquidations are piling up, retail traders are panicking, institutions are deleveraging, and everyone wants answers. What exactly sparked this? Why are four seemingly different asset classes crashing together? Is the long-term bullish case dead, or is this just the kind of brutal flush that clears the way for the next big leg higher? I'm going to take you through the entire story from start to finish. No shortcuts, no glossing over details. We will walk through how the setup built up, the exact moment everything flipped, the technical and mechanical reasons the move accelerated into a rout, the precise price action and levels we are seeing right this second, the deep correlations that linked these assets, the wider macro backdrop that is feeding the fear, and then a layered, realistic outlook. What could happen in the very short term, days to a couple weeks, the medium term, rest of this year, and the long-term structural drivers that might still make these assets huge winners despite the pain we are feeling today. This is the full, unfiltered breakdown you need if you are trying to make sense of the madness and decide what to do with your positions. Let's rewind to set the stage properly. Late last year and into the opening weeks of 2026, these markets were in full-blown euphoria. Gold had climbed to astonishing record highs around $5,600 to $5,608 per ounce. The drivers were stacked. Multiple rounds of Fed rate cuts through 2025 had weakened the dollar significantly. Tariff rhetoric was heating up again. Geopolitical headlines kept popping. Iran tensions, Venezuela political drama, various European and Middle East flashpoints, and there was growing market chatter that the Federal Reserve's independence was being tested by political pressure from multiple angles. All of that combined to make gold the ultimate hedge against uncertainty and currency debasement. Silver took it to another level, rocketing all the way up to $120 to $122 per ounce. Beyond safe haven buying, silver benefited enormously from real-world industrial consumption. Solar panel production is exploding globally. Electric vehicle batteries and electronics demand keeps rising. Green energy infrastructure projects are ramping. That fundamental tailwind, mixed with heavy speculative positioning, pushed silver into parabolic territory faster than gold. Bitcoin was part of the same risk-on, anti-fiat narrative, peaking near $96,000 plus earlier, riding ETF inflows, the digital gold storyline, and signals that the current administration is crypto-friendly. Oil had steadier upward bias, supported by lingering supply concern narratives even as some geopolitical risks appeared to moderate. Then the single biggest narrative shift hit. President Trump nominates Kevin Warsh to become the next chair of the Federal Reserve, replacing Jerome Powell when Powell's term concludes in May 2026. Warsh is widely regarded in market circles as a hawk. During his time as a Fed governor, he consistently emphasized central bank independence, was cautious about prolonged easy money policies when inflation signals appeared, advocated for more aggressive balance sheet reduction, and generally favored tighter conditions than the dovish wing. Traders had been positioning aggressively for the opposite outcome, a successor perceived as ultra-dovish who would keep rates low for longer, deliver more cuts if growth slowed, and perhaps even lean toward balance sheet expansion in a pinch. That forever easy expectation had supercharged the hard asset rally. Warsh's name surfaces, and the entire debasement trade thesis cracks. The US dollar index immediately surges, delivering some of the strongest consecutive daily gains seen in months. A stronger dollar instantly makes commodities priced in dollars more expensive for buyers using euros, yen, yuan, rupees, and so on. At the same time, the opportunity cost of holding non-yielding assets like gold and silver rises sharply. Why tie up capital in zero-yield metals when treasury yields might stay higher for longer and rate cut expectations get pushed out? That narrative reversal alone would have caused a healthy pullback, but the positioning was so crowded and leveraged that it turned into something much uglier. Friday's session became legendary for all the wrong reasons. Gold plunged more than 9% at one point, testing lows near $4,400 before buyers tried to defend. Silver's drop was apocalyptic, 30 to 31% in a single trading session, triggering futures halts and wiping out speculative longs en masse. The white metal went from moonshot euphoria to absolute despair in the span of hours. Crypto was caught in the crossfire through a mechanism many people still underestimate: portfolio margin contagion. Large hedge funds, prop desks, and sophisticated traders frequently use cross-margin accounts where positions in metals futures, crypto perpetuals, equities, and other assets all serve as collateral for each other. When silver and gold futures cratered, initial margin requirements spiked, equity in those accounts evaporated, and automated margin calls fired across the board. That forced liquidation of Bitcoin futures and spot holdings to raise cash and meet requirements. Liquidation data showed over $1.7 billion in crypto positions wiped out in the initial wave alone, creating cascading stop-loss triggers and a self-reinforcing downward spiral. Weekend and early Asian session liquidity was razor-thin, so every sell order moved the market disproportionately. Algos piled on, gamma exposure flipped negative, and the whole thing snowballed. Oil's decline, while less extreme percentage-wise, fits the same pattern. WTI crude has fallen toward the $63 to $64 area recently. The key driver here was a rapid evaporation of geopolitical risk premium. Trump administration signals pointing toward possible direct talks with Iran reduced immediate fears of Strait of Hormuz disruptions or major supply shocks. Combine that with the stronger dollar weighing on all commodities, and the general risk-off rotation out of anything cyclical or inflation-sensitive, and oil naturally softened. The reason everything crashed in concert is that these assets, despite different stories, are all highly sensitive to the same macro switches flipping at once. Risk on to risk off, dollar strength, shifting Fed expectations, and leverage unwind. Precious metals are classic inflation and uncertainty hedges. They get destroyed when a hawkish pivot makes real yields more attractive and the dollar rallies. Crypto, for all its digital gold marketing, trades like the highest beta risk asset on the planet during deleveraging episodes, dumping hard whenever equities or commodities crack. Oil is the ultimate global growth and geopolitics barometer. Cooling tensions plus dollar headwinds equals lower prices. Current snapshot: prices moving fast, but as of the latest ticks, gold is bouncing somewhat and sitting around $4,860 to $4,970 per ounce after the deep crash lows. Silver remains extremely volatile, trading in the $75.83 to $91 range depending on the hour, off massively from $120 plus highs, but showing signs of short covering. Bitcoin is clinging to the $70,000 to $70,900 zone, critical psychological and technical support. Oil WTI around $63 to $64, testing lower levels but not yet in free fall. Volatility is off the charts across the board. Looking ahead. Short term, next few days to a couple weeks. Expect continued chop and headline-driven swings. Kevin Warsh's confirmation hearings will be watched like a hawk. If he comes across as firmly hawkish, stressing tighter policy, quicker balance sheet runoff, unwavering independence, the dollar could grind higher and keep downward pressure on these assets. Fresh margin calls or technical breakdowns. Bitcoin decisively below $70,000, gold failing $4,400 to $4,500 could spark another selling wave. On the flip side, if hearings reveal nuance, if incoming economic data softens noticeably, weaker payrolls, cooling CPI prints, or if the market decides Warsh is not the inflation fighter some fear, we could see sharp, relief-style bounces, especially in physical metals where buyers often step in aggressively after big drops. Medium term. Through the balance of 2026, the professional consensus still leans bullish on balance. Gold price targets from major houses frequently land in the $5,000 to $6,500 range by year-end. Central bank buying remains a powerful structural bid. Many emerging market and even developed nation reserves continue diversifying away from dollar concentration. Institutional flows into gold ETFs and physical haven't reversed. Silver's path is bumpier due to its dual nature, but if industrial consumption holds or accelerates, solar installations, EV rollout, 5G and electronics, it could reclaim $88 plus and potentially much higher in a risk-on rebound. Oil faces softer near-term pressure, absent new supply shocks, but decades of upstream underinvestment mean any sustained demand pickup could push prices higher quickly. The $60 range likely acts as a reasonably firm floor. Crypto, Bitcoin's recent negative correlation to physical gold hurt its narrative short-term, but longer-term tailwinds include potential regulatory clarity, continued ETF adoption, institutional interest, and the simple fact that risk appetite tends to return after deleveraging purges. Long-term, this is where perspective matters most. Do not let short-term panic convince you the entire multi-year bull case is broken. These kinds of violent leverage corrections are standard in asset classes that go parabolic. They flush out weak hands, punish over-leveraged speculators, eliminate froth, and often set the stage for healthier, more sustainable advances. Core supply-demand dynamics have not changed. Gold and silver mine production growth remains constrained by environmental regulations, permitting delays and declining ore grades. Energy markets suffer from chronic capital discipline and underinvestment after years of ESG pressure and boom-bust cycles. Geopolitical uncertainty is baked into the system and can flare at any moment. Central bank behavior around reserve diversification continues. Physical demand, especially in jewelry-heavy markets and retail bar and coin buying, tends to surge after sharp price drops when assets suddenly look affordable again. This meltdown feels like the market's way of saying, "Slow down, you went too far too fast." The rally climbed a massive wall of worry through 2025. Now policy surprise uncertainty is delivering the gut check moment. If you believe in the bigger themes, uncertainty hedging, alternative stores of value, supply tightness, green energy transition metals, you treat violent resets as potential entry zones rather than exit signals. So manage risk ruthlessly right now. Keep position sizes reasonable, use stops where it makes sense, diversify across uncorrelated assets, and stay glued to the key drivers. Dollar moves, every Warsh headline, Fed speakers, geopolitical wires, jobs, and inflation data. Patience separates winners from those who get shaken out at the worst possible time. What do you think is the worst behind us with these tentative bounces? Or are we headed for one more flush lower before the turn? Drop your honest take in the comments below. If this deep dive helped you connect the dots and calm the nerves a bit, smash that like button, it really helps the channel. And if you're not subscribed yet, hit that button and turn on notifications so you catch the next update the moment things move again. Markets are savage, but they reward those who stay informed and keep their heads. We will get through this together. Talk to you soon.